Good morning, everybody. It's Friday, October 6th, 5:30 a.m. As I speak, grains are mixed here this morning. I have Matt Bennett on with me. Yesterday, we saw a Turkish cargo ship strike a mine in the Black Sea off the coast of Romania. The ship reported only minor damage and no casualties. This is one of the first incidents involving a ship hitting a mine in months. According to a Ukrainian government source, the mine was probably from World War II or landing mines that were left there last year. Of course, we all know that Russia can also use mines in the Black Sea. Grains responded positively, with wheat climbing more than 3% and corn ending the day at its highest close in a month. Overnight, however, wheat gave back those gains and sunk lower. So as I just mentioned, we haven't seen an incident with a cargo ship in a mine in quite a while. However, it's essentially just more unrest in the Black Sea, more of the same. But the grain markets, they did not really seem to care. Why is that?
The interesting thing, you look at corn, for instance, double-digit gains 2 out of 4 days this week. Yesterday was one of those days, and I can't imagine that corn was going to rally double digits without this sort of news that hit. Because people are kind of standing around saying, why is corn rallying? Why is wheat rallying? And obviously, you point towards the story that you just talked about. I think it was kind of one of those deals at first where it was a rumor and no one could really verify it. And then, it hit the wires eventually. But bottom line is, these stories haven't had the impact that they had for a long time. I mean, anytime you got some sort of news out of the Black Sea, wheat was up 50 and corn was up 20. But yesterday seemed to have a little more punch to it. So, I've got my theories as to why corn continues to stay strong. I think yesterday this was part of the reason, but we are setting crop insurance this month, and I do think that the tendency, whenever you're this drastically below the insurance price, for this magical rally to occur, it just seems to happen more often than not.
So we saw oil prices fall another 2% on Thursday as concerns over the impact of high interest rates on the global economy increase. Experts believe peak consumption for the year is behind us and won't ramp up again until the holiday shopping season. WTI closed at 83.31 a barrel, falling beneath its 50-day moving average for the first time since July. Brent crude ended the day at 84.07 a barrel. Both WTI and Brent crude have lost $10 a barrel in the last 10 days. With oil prices continuing to slump, is this just another signal that a recession is on the horizon? And in your opinion, how low could we see prices go? Because obviously these worries over demand, they're not going to go away because interest rates, they're going to stay high.
Yeah, I mean, you just said a lot there. We actually talked about this a little bit on Wednesday. I guess I kind of threw out there that I do have some fears of recession. I know that though that talk kind of, in essence, went away. But whenever you continue to talk higher interest rates, whenever you see, for instance, the equities plummet, there are indications, and some folks out there talking for a massive meltdown actually in equities. If you see something like that happen, then by all means, a recession is something people are going to be talking about in much greater detail. But I think the latter part of your question is, how low can crude go? Do I expect this sort of price action to continue? And bottom line is, as you said, $10 over the last 10 days, that's a bath. I mean, we've definitely turned the trend for the time being. I don't want to sit here and say, I think we're just going to bounce right back to 90. I'm not sure that's going to happen. And there's no question that whenever you get past your summer driving season, typically you see demand go lower. And so my personal thought is that oil's probably in a path of least resistance is lower type of trend right now, which certainly spills over into what we're growing in corn and soybeans whenever we're talking about growing for biofuels. So, it could definitely tighten margins up. It's certainly not going to be something that I would say is positive towards demand.
So, some news out of Argentina this morning. Two-thirds of Argentina's soybean processing plants will soon sit idle due to a soybean shortage. Last year's historic drought cut the country's soybean crop in half. Soybean stocks are also down due to the government pushing exports of beans to increase revenue. Between January and August of this year, crush volume fell 27% year over year to 19.6 million, the lowest level for that period since 2015. To keep facilities open, Argentina is forecast to import a record 10 million tons of soybeans this year. So, will this situation have any impact on our markets here in the US? Could we see Argentina import more US soybeans?
Oh, I think it's possible, but they're more likely to import, of course, from their neighbor, Brazil.
Right.
The thing that I've pointed to for a while now, of course, as you see more crush plants either being built or planned to be built, as we continue to talk about this renewable diesel situation, is that we're going to have, if we're trying to produce a whole lot of soybean oil, what are we going to have a whole lot of? And that's going to be soybean meal. So, Argentina's been up to 50% and above as far as your world soybean meal exports go over the course of time. And I think that their day in the sun, so to speak, is going to be over with. I'm not saying they're not going to export a lot of soybean meal. I do think that they will. I think the U.S. is going to export more soybean meal every year over the next 3, 4, 5, 6 years. And so, I think that there's no doubt whenever you see Argentina have a bad bean crop and they start importing soybeans only so they can continue to crush, it tells you just how massive that crushing industry is for them. But the bottom line is right now they're kind of behind the eight ball, and the government trying to get them just to sell soybeans in whole. Obviously, the producer has been rewarding that program, so I think it's going to be an interesting development moving forward. But once again, I think the U.S. is set to take more of that world market share.
So, as facilities sit idle, will this have much of an impact on major grain traders such as like Cargill and Bunge, who obviously have plants down there in Argentina?
I mean, you'd have to think so, but I mean, that's why they're talking about importing 10 million tons of soybeans as well.
Right.
So I think that they're going to try to keep as many of these plants going. But the bottom line is if they're selling soybeans in whole, I mean, and then they're going to import them, obviously there could be some logistical issues that could make that actually economical. But at the same time, it's just going to be interesting to see what I see as a bit of a scrambling around, if you will, to keep this industry going at a time whenever it's going to be really hard to do so because you just had an epic drought. I mean, there's no
Mhm.
question that you're going to see ramifications from that. And one of those is probably going to be that several of these plants are going to have to sit idle for a while.
Right. So we had weekly export sales yesterday. U.S. corn export sales increased substantially last week. Net corn sales of 1.8 million metric tons for the current marketing year were near the upper end of expectations and up a whopping 116% compared to the previous week. Mexico was the largest corn buyer. Net soybean sales of 808,500 metric tons were up 20% versus the prior week and at the upper end of expectations. China was the largest soybean buyer for the week. Net wheat sales of 273,100 metric tons were near the lower end of expectations and down 50% from the previous week and 34% from the prior 4-week average. So corn export sales were fairly robust this week. Obviously, accumulated corn sales for this year are now running a little over 8% above last year's pace. A minute ago, you talked about the little bit of corn rally that we've had, the corn market rally that we've had this week. These increased export sales, is that attributing to that?
Yeah, I've got to think that it certainly played a role yesterday in a bit of support. I think that the double digit type enthusiasm probably had more to do with this ship situation, but there's no doubt that exports were supportive in nature. The thing is that most people who watch the Morning Wire know that there was a fair amount of purchases last week from Mexico, and thank
Mhm.
God for Mexico whenever we're talking about corn exports. Obviously, we've got the infrastructure in place. We rail pretty much all, if not 100% of that corn down to Mexico, and they can do so fairly economically. Obviously, there's been times here in the last several months that we haven't been super competitive on the global market, but that would be at the ports. And so Mexico is a little bit insulated from that. It's a big reason why they're probably going to be our number one importer of corn this year. And so we've got to hope that they continue to import U.S. corn. I'm sure hoping, and I'm just guessing that China's going to import some U.S. corn at some point. Now, who knows whether it's going to happen or not? But I've got to think exports are going to continue to kind of languish around here at a level where we may end up actually getting to the U.S. Goal, if not exceeding it. If we can get something positive to happen in the way of China. But by all means, yesterday I've got to think that some of the support was attributed to what we saw out of Mexico.
So the US may be facing another rating downgrade. Moody's Investor Service has warned that the US government shutdown could result in a rating downgrade. The 45-day temporary spending bill will run out in mid-November, opening the door for the potential of another government shutdown. Moody's has also said intensifying political polarization is a concern. In August, the U.S. debt limit prompted Fitch Ratings to reduce its U.S. rating from AAA to AA+. Nevertheless, U.S. debt, which has now surpassed $33 trillion, may outweigh the importance of credit ratings. So if the U.S. does lose its last AAA rating, what kind of impact will that have on our country when it comes to the global financial markets?
Where do we start here,
Yeah.
Kenzie? 33 trillion. Guess who's going to pay for that? Your kids are going to pay for that. Your
Oh my
eventual
goodness.
kids someday, probably. But I don't know. In all honesty, it's a scary situation. We don't even have a Speaker of the House right now. I
I
mean,
know.
I don't want to talk politics much, but if these clowns can't get a Speaker of the House elected here very rapidly, then you've got to think that this government shutdown that could be impending would happen. I don't know. I mean, to me, polarization is another thing that you said in this
Yes.
article from Moody's. Well, of course, when you've got people to where they can't just sit down and have a discussion about some rational spending, and quite frankly, $33 trillion. Are you kidding me? Is there ever any chance that you're going to get this paid for? And so if I was Moody's, I think I'd have downgraded them a long time ago. I mean, it's a scary situation. It's a frustrating situation. And, it's just like anything else. If you continue to spend money that you don't have, we're sending money all over the world that we don't even have. If that's the case, it makes it frustrating for people like you and me to pay taxes, right?
Yes, it's incredibly frustrating. And as you just
Right.
said, we don't even have a Speaker of the House right now, so they can't pass any legislation. And that 45-day time frame that we have before we face another government shutdown is going to be here before we know it. You know,
Absolutely.
you
There's
know.
no question about it. So, it's a scary situation. I mean, that's all there is to it. It's a frustrating one. It makes you worry for the future. We
Mhm.
certainly need some sort of leadership to come into place at some point that could come in with some rational discussion that's not just talking some political gibberish, because quite frankly, I don't care whether you're a Republican or Democrat. Most people are getting tired of it. And I
Mhm.
think people are sick of politics in general. And if these guys can't get this straightened out here very rapidly, in my opinion, it's going to spell a whole lot more than financial issues, I'm afraid. So let's
Yeah.
just hope that they can get some sort of leadership in place and get some, again, rational discussion for a change, and be able to come to some sort of conclusion as far as avoiding this shutdown and maybe get spending under control.
Yeah, one can only hope. So, USDA released weekly drought monitor data. Drought conditions worsened across Indiana and Ohio this week, as many areas received less than 25% of normal precipitation over the last month. Eastern Iowa also saw conditions intensify. Heavy rainfall improved drought conditions in parts of Kentucky, southern Illinois, Minnesota, and Wisconsin. Conditions across the high plains were mostly unchanged this week. So when we look at the percentage of US areas experiencing drought, 59% of corn country, 58% soybeans, winter wheat, 49% spring wheat, 51%, and cattle country, 47%. So there weren't a lot of big changes when it came to the drought across the Corn Belt this week. We talked a little bit about this in Wednesday's premium video,
Mhm.
but what are you seeing? How are the drought conditions impacting harvest in your neck of the woods?
Yeah, and so yesterday, actually, we received an inch to an inch and a quarter of rain. First time we've had rain in quite some time. We really haven't had any disruptions to harvest since we got started there. Oh, I don't know, the 10th of September. And so we would have been done by Saturday night if we wouldn't have had it rain. A couple of my buddies were texting me, this freaking rain. I'm like, you know what? Nimrod, it's freaking cold out. It's dry. It's dry as can be,
Yeah.
and now it's going to get cool. You're going to get a little bit of moisture in the soil. We need moisture. Holy smokes, Kenzie! If you know the dryness level that we're at right now, if we go into winter, typically an El Nino winter is a little warmer and drier than normal.
Hmm.
I've got serious concerns as to how we're going to start next spring if we don't start getting some moisture. I know that El Nino was supposed to be a situation where towards the end of the summer, maybe we were going to go ahead and get some moisture, recharge things. But in my part of the world, we are dry now. Nothing like you experienced for a couple of years. I mean, there's no doubt that
Hmm.
it's not to that level. But what I'm looking at is nobody's mowing their yard. Everybody's pastures are dead. There's literally no hay. The hay market is going to be on fire this winter. There's no question in my mind that that's going to be the case. And the more overriding factor, I think, once again, is if you can't get some relief here, two things. The Mississippi River situation is going to plague us all winter long, I'm afraid. First of all, and second of all, you're going to go into spring with very little margin for error whenever it comes to Mother Nature. So this drought situation just seems like it won't go away. We've got to hope that this fall. I know if you're a producer, you're gonna be like, this freaking Matt Bennett guy. I don't like him very much. We need rain. Yeah, I know you want to get done farming. I totally get that. We need some rain though. I don't want you to mud stuff out. But we need to get some moisture going here in the heartland. If we don't, I'm pretty concerned.
Yeah, definitely looking ahead to next year is awfully concerning. Cattle futures were mixed on Friday. Feeder cattle futures closed an average of 65 cents lower. Live cattle, they closed mixed from an average of 48 cents lower to an average of 27 cents higher. Box beef had a positive day. Choice ended the day at 297.76. That was up a buck. Select ended the day at 274.77. That was down 10 cents. Let's touch really quick on cattle. Obviously, outside markets are impacting these cattle markets because obviously the fundamentals are strong. We've talked about this 1,000 times. But when do the fundamentals, as in the record low numbers, take over the outside influences? When does that play come into play a little bit more?
Okay, that's a really good question. And so you got to ask yourself, with this a futures market, as we know, and so did a lot of that get factored in on the run towards $200 in April? I don't know. I mean, I think that a lot of folks looked at $200 as like this level that if you get above it, you're going to have a hard time sustaining any measurable rally above it. And so, if someone's looking for a really bullish scenario right now, especially considering what you just referenced with the equities, I struggle to see it now. Fundamentally, this is just a really dynamic market.
Mhm.
You can make a case for higher prices no matter what you're talking about today. The problem is that we've already again tried several times to bust through this $200 level in April. And so I think that what it's going to take, Kenzie, is you're going to need to see a cattle on feed report, in the 85, 86, 87% of a year ago type level, which I think is going to come. I mean, most people know that's going to come. If
Mhm.
you guys are all able to throw these gals out on pasture instead of into the feedlot, then that is definitely going to be, in my opinion, one of those things where, hey, we've talked about it. Finally, we see it. Once you see it happen, then I think that could be the thing that could push you up and over. But you've got to always remember that whenever it comes to cattle, it's how the consumer feels about whether they're going to be able to spend the money on a T-bone steak or if they're going to buy a pork chop. And that's no disrespect to anybody. It's
Right.
just that if the consumer doesn't feel like they can afford this cattle thing and eating beef like we've been eating for the last 3 or 4 years, then you're probably going to see the shine off of this. I still think we see $200. I think the market wants to see it, but whether we get much above it, that's a different story.
Yeah. All right. Well, thank you for joining me here this morning, Matt. Everyone have a great day, and we'll talk to you on Monday.